Hello, I'm Harriet Davies, a reporter at Wealth Briefing. Welcome to the first episode of Wealth 360, part of our exciting new TV channel, Wealthview. I'm going to start by talking about the growing use of structured products in the investment space by talking to Russell Catley of Catley Lakeman Securities. Next up, my colleague Wendy will look at how internet entrepreneurs are choosing their wealth advisors by talking with Giovanni Amodeo of Merger Market. Also, I'll be talking about the use of passive funds and especially ETFs in an investment portfolio. I'll be talking about this with wealth advisor James Sellon and research specialist Simon Smith of ETF Strategy. We wrap up the show today by working out how private clients use the internet to pick an advisor with Dominic Gamble of findawealthmonitor.com. We'll cover a wide range of issues in today's programme, but we rely on you to tell us what you want us to cover, so do get in touch, and we hope you enjoy the show. I'm delighted to be joined by Russell Catley of Catley Lakeman Securities. Russell is a founding partner of Catley Lakeman and has been in the industry for around 25 years now. Before setting up his own business with his partners, he was head of UK structured products at Citigroup. Russell, could you tell us a bit more about what Catley Lakeman does?
Yes, absolutely. We effectively sit between the investment banks that issue structured products and the client base, which is predominantly wealth managers, discretionary wealth managers, some fund managers, some small institutions, and some of the smaller private banks. And what we do as a firm is we do pretty much everything up to the point of trade. So we structure the ideas that the clients are looking for, we package them together as securities, we price them, we then go and negotiate essentially the price and the structure with a particular bank. We then, up to the point of trade where the client faces the bank in terms of the trade, thereafter we then run the secondary market, so all the buys and sells and up to maturity of the product essentially.
And where does the value lie today in structured products?
The value in structured products essentially is in three things. Firstly, the volatility in, let's say, the equity markets. So what we're selling people really is the volatility in, say, the FTSE or the S&P 500. The second thing that we're selling is correlation, which works very, very well at the moment, where historically most equity markets have been extremely well correlated. That's not been the case so much over the last 2 or 3 years, where, as we know, the S&P 500, for example, has performed better than the FTSE, which has performed better than the Euro stocks. So within the disparity between that correlation, there's some value there. And the third thing is essentially credit. So the investment banks providing the products will pay you a little bit of credit funding. The quality banks don't pay so much, but obviously there's a trade-off between getting paid a lot in terms of funding and having the highest quality banks possible. So those three things really we package together in terms of how the structure works. And the three things are used to offer or to produce the product that actually the client is looking for.
And are you seeing any interesting trades going on at the moment, driven perhaps by what's going on in the markets?
Yes. What's happened over the last 6 months since the market started to rise is that so credit funding for all the banks has become very, very tight, so you're not getting paid a huge amount for that. Volatility, as is always the case when markets go up consistently, volatility has come off, so it's much lower. And given that we're selling volatility, we're being paid less for selling that volatility. So those two things have made prices much tighter. There's not quite the value there was a year ago. But where there is value essentially is correlation. And I mentioned earlier that if you look at the three major indices used in structured products, which will be FTSE, S&P 500 and Euro Stoxx 50, the correlation of those three is much lower than it has been historically. So you get paid quite a lot for that lack of correlation. So if you use, say, a dual index product, so FTSE and S&P 500, where both have to be over a certain barrier to get paid a coupon, you get paid an awful lot more than just using the FTSE. And just as a rough example, I think we priced up an auto-callable this week with defensive barriers, which on FTSE alone would have paid about 7.5% coupon, whereas FTSE, and actually in this case Eurostoxx 50, was paying over 10. So, you know, it's quite a pickup in coupon for using sort of that lack of correlation between the indices.
Russell, thank you very much for joining us today.
Pleasure, thank you.
I'm delighted to be speaking to Giovanni Amodeo, editor at Wealthmonitor today. Giovanni, could you tell me a little bit about your role? You've been in the role for 8 years now, and the organisation and what it does.
Of course, Wealthmonitor is part of the Merger Market Group, was founded in 2005, as you just said. Merger Market has been around for 13 years, was founded from the idea of two entrepreneurs, which were then backed by two private equity firms, which were Proven and New Media Spark. During the course of the year, the two entrepreneurs grew the business, and then they sold it to the Financial Times Group in 2006. The business continues growing and now has revenues of around 100 million.
The latest figures from your internet sector report suggest that internet entrepreneurs in Europe pocketed nearly £17 billion in 2012. What signals are you getting from wealth management firms that they're really tracking this sector as a source of new clients?
I think you need to look at the investment banking world as a whole. The relationship starts earlier than it would have 3-4 years ago. You see investment banker or M&A boutique companies going straight to the entrepreneur, helping them raise money or expand. You wouldn't have seen that 3-4 years ago. And the relationship starts then, because then the wealth management firms can go into the entrepreneur and help them with the other issues that they might have.
Do you think that it's often the case that entrepreneurial clients will want to engage in entrepreneurship immediately after a liquidity event, and what effect do you think this should have on wealth management firm strategies?
It depends at what age the liquidity events happen. If the liquidity events happens in their 30s, then definitely people want to start new venture and they need to be engaged. And one of the things that wealth management firms need to change is their attitude to relationships. So they need to be plugged into the system even more. Before, you see a wealth management firm very focused on their own business, but now they need to be able to connect the entrepreneur with other people that are looking for new ventures.
In your experience, do internet entrepreneurs or entrepreneurs in general have any clear preferences as to their wealth management provision?
They're becoming more and more savvy about their investment. They also invest in private equity instruments, which we wouldn't have seen a few years ago. They don't only look at safe investment, because they understand that they have the company on one side, but they also need to look after their investment, and they are becoming more and more expert in that field.
Thank you very much for your time today, Giovanni. Those were fascinating insights.
Thank you very much, Wendy, for having me here.
I'm pleased to be joined today by James Sellon and Simon Smith. James, can you start by telling us a bit about what Maseco does?
Sure. Maseco is a wealth management firm based here in the UK. We advise American expats living in the UK and across Europe. And we want to deliver a low-cost, passive investment experience for those clients. And we've been doing that for the last 5 years.
And Simon, could you tell us about ETF strategies?
Sure. ETF strategy is delegated to the ETF sector, obviously. We provide detailed coverage of ETFs and related exchange-traded products, exchange-traded notes, exchange-traded commodities. And essentially there's been a massive boom in this industry, but there's been a real lack, a gap in the market for detailed analysis and research, and that's exactly what we provide at ETF strategy.
James, why did you make passive investing central to your investment philosophy at Maseco?
Well, I suppose it was a function of our experience. We historically used to talk to our clients around active management and the generation of alpha for client portfolios, and it became evident to me that over time a more sensible approach to investing capital was to try and capture risk premiums that are evident in the market space and try and capture the market returns in the most cost-effective way possible. And through the advent of exchange-traded funds and asset class funds, this provided the perfect toolkit for us to be able to define the exact risk exposures that we wanted to generate using low-cost asset class funds.
And James, how does passive investment change your business model as a wealth manager? Does it change the services you provide or the fees that you charge your clients?
Well, I think, Harriet, that's actually the crux of the issue. Insofar as with the development of the passive-based investment solution, individuals can now capture generate market returns relatively inexpensively and relatively easily. And so therefore, as a practitioner or a wealth advisor, one really needs to be adding value to the client experience to justify charging a fee. As individuals could go and generate market returns by themselves through a DIY solution. And so I believe that the industry is changing, and those wealth advisors that are out there and not providing an added value solution to their clients, then they're going to unfortunately be cast aside. So I think there's going to be a real focus on providing some sort of added value, and each wealth advisory practice will have to articulate exactly what that is.
I think there's a lot of uncertainty in the market right now. ETFs have been a great thing. They're phenomenally innovative. They've really expanded the toolkit that private wealth advisors, wealth managers like James have available to them. But the issue is finding out what the business model is that works best. It's a hugely disruptive technology, and I think a lot of advisors are still finding out how to tackle it best.
Yeah, and Simon, I think that some advisors will use the ETF toolkit to be able to offer strategic asset allocation, which is in essence a 60% equity, 40% fixed income portfolio rebalanced semi-annually. And if they maintain that approach and that approach only, then they're going to have to look to other areas to be able to add value, whether that be in estate planning, tax mitigation, tax planning, etc., etc. Or practitioners will decide to use exchange-traded funds as a mechanism by which they can dynamically allocate assets or allocate in a tactical manner to be able to generate alpha and returns. So those are sort of the two areas, either the financial planning route where individuals will have to generate value through ancillary services, or actually by generating alpha using asset class funds.
I think the key thing, that the tricky issue that James has got to deal with, is that one of the key advantages of ETFs are the low cost. You can get exposure to various different markets, such as the S&P 500 now. There's a Vanguard product out there charging just 9 basis points, phenomenally low fees. That's a huge advantage to investors. Obviously, in this low return environment, fees are incredibly important, and high fees obviously eat into returns. The difficulty is, how does James come in if he's slapping on a fee on top of that? Is he just simply destroying all the value advantage?
Well, 100%. I think historically, if you look back 30 years ago, to generate market exposure, you had to visit your stockbroker. 20 years ago, you had to go and visit your insurance salesman who wrapped it up with an insurance product. 10 years ago, you visit your private banker who sold you an investment product. And now with the developments as post-RDR environment, that everyone has to charge a specific fee, individuals will now have the ability to really disentangle the fee structure by which they're paying when they are when they're generating when they're working with a wealth advisor. And so again, Simon's right that those wealth managers that are out there that are simply providing access won't be here in the future.
James, Simon, thank you both very much for joining us here today.
No, it's been good. It's been very good. Thank you. I think we're going to be continuing a few of these discussions afterwards as well.
I think we will. Harriet, thank you very much.
I'm now joined by Dominic Gamble, who's co-founder of findawealthmanager.com. Dominic, could you first of all start by telling us a little bit more about your service and the reasons why you launched it?
Sure. Well, I'm an ex-private banker by trade. I was managing money for high net worth clients in the UK. And after the crisis in 2008, one of my clients and I actually started thinking about how we could help private clients to get a better match with their wealth managers. It's a very illiquid industry, and it's very difficult, we think, for private clients to get impartial, independent information about which wealth managers genuinely suit their needs. So we thought we'd come up with something quite novel by bringing online an independent service that's new to help private clients get that match with their wealth managers via a very simple interactive service.
Dominic, as I understand it, around half of the users that come to your site are actually first-time clients. How do the other users break down?
Yes, you're absolutely right. The staggering statistic that we've had in the year or so that we've been up and running is that most of the private clients coming through our site don't actually have a wealth manager. And in several cases, the investable asset sizes of those clients has been pretty astronomical. So I think that probably the majority of clients out there who are using our service are perhaps a little lost perhaps for the first time, are really wanting to take control of their wealth. The other big areas of clients who are using our service are the ones who are unhappy, or the clients who wish to diversify their wealth amongst different wealth managers. And about a third of our users are in that unhappy category. So they have a wealth manager today, but things aren't going great.
So there are a significant proportion of clients who are dissatisfied with their provider. What are their main sources of dissatisfaction?
Predominantly, we find that the reason that clients are unhappy with their wealth manager is because of poor service. And performance really doesn't figure that much as a reason given. Fees, however, has started to come up as a reason why a client's unhappy and wishes to move wealth manager.
It's also been said to me that actually clients aren't as price sensitive as you might think. Would you go along with this?
Yes, totally agree with that. I think that service and relationship are the number one criteria for a client and a wealth manager to have a positive relationship. And I think that fees generally become an issue when that service and relationship is suffering.
Well, thank you very much for sharing your thoughts with us today, Dominic. I hope we can speak to you again soon.
Thank you.